Okay, this is Jody Garrett with Prosperity Home Mortgage. I wanted to bring you guys through a review of a loan estimate. So when we have borrowers who want to get a sense of their closing costs, and they want to know how much it's going to cost to be at closing, what needs to be known up front is that we're not going to have every single fee exact at the beginning. And so what we're going to do is you get this document. This is an official document. This is called a loan estimate, and a loan estimate is just that. It's an estimate of fees. Now, I don't like the idea personally. I don't like the idea of receiving, what is maybe soft estimates, but then getting sort of surprised at the end. The document is designed mostly to not be able to surprise somebody at the end with a higher fee that you don't have sort of any control of. So I'm going to point to this on this document, a couple of different places where there's estimates being made, and some things that you may go to various lenders and get estimates and see what they're saying and what they're estimating, and maybe you want to compare, like, well, they're estimating this to be this, and you're estimating this to be a lot higher than they are. Jody, what's the scoop? I like their estimate better. And the reality of the situation is, in a lot of stuff, it doesn't matter what the estimate is, it only matters what it actually is, right? So this isn't meant to be a competitive document for the most part, but it does have a relationship with, obviously, with what happens in the end. So let's go through this document. Okay, so in the top left, you're going to see whoever the lender is going to be, and right to the top right over here, you're going to see that this there's a sentence here that says, "Save this loan estimate to compare with your closing disclosure." So the loan estimate, this doc, and then the closing disclosure at the end, which has all of the final stuff. Now, the final version of that, there's several versions of the closing disclosure that's going to be sent to you, but the final version is the one that matters. Okay. So there's a historical relationship between these two documents. They're related and they have a similar format. But for now, we're looking at the loan estimate up front. This feeds into that at the end. Okay. So on the top left here, date, it'll have a date. It'll have the borrower's names here, the property address here. Here's the sale price. You'll see this is a 30-year purchase. It's a fixed rate and it's conventional. If you had an FHA or VA, one of these would be marked. There's a loan ID, and then there's a rate lock area here, and it'll tell you whether or not it is locked, and if so, until when. Okay. Now the loan terms, as we scroll down the page here, you can see that there's a loan amount. So this looks like it's probably about 20% down on the sale price of 470. Okay. And we're seeing here, can this amount increase? So these are sort of those questions like, oh, can this rise? Can this happen? Can this happen? And the answer largely is no, unless you want to make a change yourself as a borrower. So it can't change without your permission. Okay. This is where the interest rate goes. This part is the principal and the interest. This is the first part of the mortgage payment. So full mortgage payment is principal, interest, taxes, and insurance. And if you've got PMI, then that will show up down here too. But this is just the loan part. This is the only part that kind of matters when it comes to the actual mortgage and the promissory note, is this portion, that first part. Okay. In terms of controlling your mortgage payment, the taxes and the insurance aren't something that is in direct control of you. This is what the mortgage is, and those other things are going to rise, they're going to fall. Okay. You'll see also that there's the prepayment penalty. Does it have these features? No, very specifically. Is there a balloon payment? That's where there's a bunch of money due all at once at some point in the future. No. Okay. Moving down the document to projected payments, you've got, looks like in this case, there's no mortgage insurance, there's no PMI. So this was 20% down. So you see a 0. If it was less than 20% down, there'd probably be a number in here for PMI. Here's that principal and interest, which matches up here, right? And then the estimated escrow is the property taxes and the insurance estimate together and added together to make one number. Now, remember, you don't have a homeowner's insurance at this point, so that homeowner's insurance is estimated, right? The property taxes are probably accurate, but that homeowner's insurance isn't exact. So here's the estimate of this particular borrower's monthly payment, all in, right? And you'll see here that they are, in fact, escrowing for property taxes and insurance, both. It says yes to both, right? And an HOA payment, if this was a condo buyer, we'd have an HOA payment going elsewhere. And that is not part of your mortgage payment. So if you buy a condo or a townhouse and there's an HOA fee monthly, that goes directly to that HOA. And the mortgage payment goes to the mortgage servicer, okay? So in this, all they're doing is they're adding those two things together, taxes and insurance, and this matches this, okay? Now the bottom of page 1 is the interesting one here that we should sit on for just a moment. Here's our costs at closing, okay? There's 2 boxes, estimated closing costs, estimated cash to close. Okay, this number makes it seem like the total costs being associated with this loan are 15 grand, $15,000. The reality is a good percentage of this figure is not transactional fees. It's being banked in the future on behalf of the borrowers to pay their property taxes and insurance, but they're not transactional fees, okay? When you see estimated closing costs, you have transaction fees, and then you have escrow fees, and those two things together are added, and they come up with one number. But this isn't a total fee schedule. This is some of the borrower's escrowed money and some transactional fees, and I'll get into that in a second. This is the estimate for cash to close. It's likely high, and that's how we like to set it up, where this number is intentionally high so that over the process, over the course of the loan, this will go down and down and down. Okay, let's move into page 2. Oh, by the way, one last thing. These two numbers are not added together. This number, this 91,986, that's the number that matters. Okay, this is separated out, but is already incorporated in this number. This is the only number. When asked the question, how much do I need to bring to close? I would be telling this borrower $92,000, right? Not 92,000 plus 15,000, just this number, okay? All right, page 2. This is where the fee schedules are laid out. You can see the document itself is laid out in a half and half way. There's loan costs, and then there's other costs. And I'm going to break these down individually, okay? Okay, page 2, section A is where the lender fees go. This is the only place in the document where the lender is making any money. This will almost always have 1 or 2 and sometimes 3 lines, but generally speaking, only 1 or 2. This number, which is the origination fee, that is the break-even fee for the lender to pay all the salaried people who work on the loan. Okay, this is generally speaking going to be between $1,000 and $1,500. At the time of this recording, this fee has moved up to $1,250. Okay, so this is $1,250. This was a loan estimate from a previous loan from several years ago. And in this case, borrowers don't have any points charged, but that's absolutely a possibility. On average, people pay about a point into their loan to get their interest rate to a place that's better. This is the only place where the lender's making any money. Okay, page 2, section A. Section B, services you cannot shop for. These would be very typical here. So there'd be an appraisal fee. Credit report fees have risen to about $40 per credit report, maybe more by the time that you see this. Flood cert and tax services largely stayed the same. This platform, this tech fee is now probably $95, maybe $100 by the time that you see this. So these are things that you can't go out and get your own appraisal. This has to be done by us, by law, okay? This is the biggest one in section C, the biggest one that we don't know for sure what it is, and that's the title fee. Now on your disclosures, you'll see that the title fee, you'll have an option of, do you want to choose the title company or do you want the lender to choose the title company? In Illinois, if you're looking at this and you're buying in Illinois, you don't have a choice. The seller's attorney chooses which title company that's going to be used. And at the time that you receive a loan estimate, they won't know which title company they're going to use. So this is an example of how we can't possibly know what an exact fee this would be. If they don't know, then they don't know what the fee is. So how could we know, right? But we can estimate based on history, based on data points, rate cards. We can estimate what this would be. And in this case, it's a $470 purchase price, and it's estimating it the title fees to be about $4,500. And that's about right. Title fees can be anywhere between $3,000 and $6,000 depending on the purchase price. Okay, usually not much lower than 3, usually not much higher than 6. But that's a pretty wide range, right? So it's just something to keep track of. Section D is a summation. It's A plus B plus C. So it's just those first 3 sections added up. We're already at $6,300, right? But on average, this is about, these are what you would term transactional costs. You're paying a lender for a service, right? You're paying an appraiser for a service. The credit report provided. The tech fee was a service, right? There's a tax service. The title is providing the service. Title company is who's going to settle the transaction and make sure that you're not buying a property that's got more debt on it than you'd want to inherit, and that the property lines are good, and that there's no liens outstanding on the property, et cetera. They're providing a service and then making a charge for it, right? So we're at $6,300 in about total fees, okay? Those are bona fide transactional fees. On the other side of the document, those continue a little bit, and then we get into the borrower's piggy bank, future piggy bank funds, and we'll get into that in a second. In section E, we'll see that there's a government recording fee. Now, these are government fees, right? So the government's going to take a little bit. If there's a transfer tax within that community, it'll show up right here as well. So that's what I would term a transactional fee too. You're paying a service, not getting anything but the service back in return, right? And that's listed on the document. So we can say, call that 200, we're at about $6,500, right? When we put that together with this number, right? And now we go to sections F and G. And sections F and G are the borrower's own insurance premium paid at closing, prepaid interest, that's every day from closing to the end of the month. Banks don't skip interest. And in section G, initial escrow payment at closing, we've got 3 months of escrow for the insurance, and 4 months in this case. This is closing date and county specific. So this will move, this will change depending on the county's schedule. And you'll see that this was 4 months of property tax escrow. And this adds up to a little over 5. So between these two numbers, it's a little over $7,000. So go back to the front part of this. $7,000 out of the 15 is the borrower's piggy bank for the future obligations for tax and insurance. Those are not transactional fees, yet they're put into this box. Okay. The last section in F is 2 fees. One, you'll have an attorney. If you're in Illinois, you'll have this attorney fee because Illinois is an attorney state. This is an estimate. Obviously, if we don't know who your attorney is, we don't know what the fee is, but we can estimate it. We estimate it to the high side. Most attorneys won't charge any more than $750. This is an additional title fee that comes in that the seller will ultimately pay, but it got listed here. This is a summation of this side of the document, E, F, G, and H. And here, down here, is basically the left side of the document, this, plus the right side of the document, this. And we got to 15. But remember, over 7 of that was the borrower's future tax and insurance. Okay. So if you wanted to estimate about how much of this was transactional costs, closing costs, you'd say about eight or so $1,000. And I'd say that that's pretty accurate. $8,000 to $10,000 in Illinois is about, on average, what people pay. Here's the last part, calculating cash to close. Some things to note, the deposit is your earnest money. This very often will not show up on a loan estimate because we don't have the receipt yet, or because we want to be conservative and we haven't verified it yet, whatever the situation is. But this will oftentimes on a loan estimate be zero, okay? Eventually on a closing disclosure, remember this, closing disclosure, all of your earnest money, whether it was in one check or two checks, it'll all be added up and reducing your cash to close. It's the same as handing you the checks back, is to just reduce the amount that you're bringing to close. So that's what gets done in most cases. This is where you can reflect, yes, my earnest money is being reflected, yes, okay? Any additional funds from the borrower. If there was a seller credit that was going to be adjusted during the attorney review period, it would show up here. So it makes sense on a loan estimate that there would be nothing here because you haven't had an attorney review process yet. And this section right here is where the seller's tax credits would be given to you. Now, again, on a loan estimate, very often this would be zero, okay? Because we wouldn't want necessarily to put all these things in. I'm just putting these things in now so that you have a sense of what each thing would be and what it can be. But typically this and this earnest money would be zero. And by the way, this amount is usually conservative, but when it's done, this number, the tax credits that you receive, offsets this number. So you're impounding $4,700, but you're receiving a little over $10,000. It's not for you to necessarily understand on this video, but just know that this being a charge is on the same document being offset by a credit. And this is your estimate. Okay. It'll be the same when you take a look at your loan estimate, and we can take a look at a closing disclosure too and do a review. But that is a very slow motion review of a loan estimate. I hope you found it helpful.